Hey, good evening everyone. How are you guys doing, my friends? So today I want to talk a little bit about options trading. Now, options trading is everywhere on the stock market. Most people are options trading. You see it most with day traders, but you could also take a little while. You could do monthly options trades. You could do yearly options trades if you like. But the advantage of options trade is that you can make a lot of money in that short term, but you also have that risk where you could also lose a lot of money in that short term. So let's get started. Let's talk about what options are and how you could perform them. Let's go over quickly what an option even is. So an option gives the investor the right but not the obligation to buy or sell a stock at an agreed upon price and date. Now if you're not quite sure what that means, that's alright. What an important key note to know is that when you are buying an option, you're buying a contract, and this contract represents 100 shares of that stock. Now, at that point, you're not actually buying 100 shares of the stock. You're buying a contract that allows you at a later time to execute it and buy 100 shares of the stock. Or if you choose to, you could just sell your contract without ever executing it. So you don't have to buy 100 shares of stock. Alright, so here we are on Hood. So now we just gotta find a stock. We're just gonna use Apple for example. And to trade options, we would just press on Trade Apple Options. There are three characteristics of options that you should be aware of before placing your option. So the first one being what type of option, so either a call or a put. The second being what you want to set your strike price at. And the third one being your expiration date. So you have two choices when you're placing your option, and the first one being a call, in which case you're expecting the stock to go up, and the other one being a put, in which case you want the stock to go down. Now when you set your option type, which is either a call or a put, you want to set your strike price. So let's say you have a call in and you want to set your strike price for 112.5. So what you're expecting is that this stock will be above 112.5, above because it's a call, above 112.5 by your expiration date of next Friday or October 2nd. So right now this share price is at 112.24. So you're expecting by next Friday this stock will be above $112.50. Now with a put, you're expecting this stock to go down. So you would probably want to place one at $110. So what you're expecting is that this stock will be below $110 by next Friday. And if it is, you'll receive profit. So let's give a little example here. What would happen in a typical options call? So let's say you have a call and a strike price of $112 and an expiration date of 10/2/2020. So as you can see, you start off and you start to make it inside of or above $112. Then it goes down a bit, and then when it comes to the end of your week, it starts to go up and it starts going way past your strike price. So when it's above $112 or your strike price, you're considered in the money. But where in this section right here, where you are under $112, you're considered out of the money. So what happens now when you reach your expiration date, but your option has not passed $112 and you're out of the money? Well, what that means is your contract is worth $0. It has expired worthless. So let's say now let's pull up back Robinhood real quick. So let's say you bought this contract, so this Apple contract, for $2.56 a share, which is $256 for 100 shares. What that means is this will now be worth $0 and you would have lost all your $256. So the advantages of contracts. So let's say earlier on where we were in the money, we have the ability to actually end our trade right there and close it and just sell it off to someone else. Or if we wanted to, we could execute it. But it's not that great of an idea to execute it. due to intrinsic value and extrinsic value. So we have the ability to close it right here and still make our profit, but not as significant of a profit if we were to wait right here. And that's due to a reason known as time decay. So time decay can be either advantageous for you or it could be bad for you. So in the situation where you're considered out of the money or you were below $112. So in this scenario, let's say you paid $256 for your contract. Over time, if you stay out of the money and on your expiration date of next Friday, or let's say on your expiration date, you're below $112, your option will have decreased in value over time and has reached $0. But now what happens if you are in the money? Whoops. Let's say you're in the money. What happens to the value of your option? So let's say you paid $256. So time decay works differently. So at the beginning of your option, so let's say today is 9/26/2020, and this is the expiration day of next Friday. So at the beginning of your options, your option will not generate too much profit. It might be maybe $10. And then over time, if you're in the money a bit later on, now it's worth $50. But now on expiration date, time decay takes effect, and now you have a profit of maybe $150 for your contract. So over time, your contract just starts to be worth even more as long as it's in the money. But for the opposite, if you're out of the money, your option starts to expire worthless. Alright, so just a wrap up for the video to end it. So pretty much with options, you're either expecting the stock to go up or the stock to go down within a certain time frame. And if you were to close your option a bit earlier on, you would not make as much value out of it as if you were to wait until your option expires, in which case you would make the maximum amount of profit, or in the case that you're out of the money, you would make $0 or your contract would expire worthless. So options do get a bit more complex, and you don't only have to play for the stock to go up or the stock to go down. There are neutral strategies, in which case you would operate a option spread, which are multiple different options rather than just putting in a call or putting in a put. And I plan on making a video for that too. That's probably going to be my next video. I'm going to describe a bit of option spreads, and it gets a bit more complex, but this was just the basics. So if you liked the video, I appreciate if you left a comment, just letting me know if you liked it. If you have any questions, feel free to message me, place a comment. You can message me on my Snapchat. This is mainly just meant for my friends, so I probably have you guys on Snapchat anyway. So I hope you guys have a great day, and I'll see you around.